you're in a buy the dip mood now. That time is back to the extent that we have these dips.
Yeah, I think last year's stocks in that waterfall decline priced in a recession. Earnings, I think, are showing it's more speed bump than economic contraction. And, the Fed's turned less hawkish. And I think that with positioning is the best kind of odds for up year since 2009. So, yeah, I think people should be buying the dip.
To what extent are you watching these earnings and getting new information from them, or are they just confirming your mindset coming into the year?
Well, I think that they've allayed the worst fears. I think people thought that trade and the shutdown and the decline in markets, and you saw like even some of the regional surveys like the Philly Fed kind of showed contractionary dynamics, but it turns out, it's still a decent earnings season. So I think it's good news overall.
David, your read from the Fed and how that affects your outlook for the year?
I might take the other side from Tom. No doubt about it. The market discounted weakness given that really sharp decline that we had in September. And we got so oversold that, and by some measures, it was almost you could go back to the beginning of prior bull markets, the beginnings of bull markets, it was so oversold. But it's interesting now that Fed Chairman Powell is much more dovish, kind of similar to where maybe prior Chairman Yellen was in 2016, which set the stage for that remarkable 2017 year for the stock market. But I think what's different this time, and it's significant, is I still think we need to digest the Fed tightening. Certainly the stock market sniffed that out. But, we're even starting to see some internal data in the employment surveys, some consumer confidence. Within those data points, we've had 3 or 4 months now of some weakness. And so I think stocks have to earn this sharp rally they've had. The market has only recovered about half of its decline. Bond markets, if you look at the 10-year, its yields have only gone up only about 25%. I think the bond market's telling us something here.
I want to dig into that a little bit more because the idea of what this means for earnings, you've got latest estimates from Refinitiv, Q1 EPS growth now expected to grow at just 0.5%. Do you think we could actually see an earnings recession here this year?
I think so, yeah.
What does that mean for stocks and valuations?
The more cyclical ones have to earn their keep. Look what almost all the big tech stocks have individual stories where there's been some weakness. Interesting, tonight we have Alphabet. That stock corrected pretty hard, and I would argue that the core Alphabet, core Google, is probably the cleanest growth story in tech. But I'm from the show me state. I think each individual stock and sector has to prove itself and show that maybe we're not in an earnings recession. I think it's a 50-50 toss here.